All right, we are live. Several things to go over today. Obviously, interest rates, the big topic of conversation. Of course, it's going to be when you're in the mortgage business. Hey, what are interest rates? What are interest rates? What are interest rates? Improve my lower third. Don't have to hide as much here. That's my phone number. That's my NMLS. If you have questions about mortgages, that's what I'm here for. But I want to go through kind of what the Fed has said this week in a very important meeting and release of notes. In fact, it was a virtual meeting. It was like a Zoom conference, which is pretty cool to watch take place, where reporters were asking, Powell questions. Anyway, we're going to get some insight into what they're thinking for the long-term interest rate forecast. Also, look at mortgage bonds real quick. Can rates go lower? I mean, have we seen the lowest rates that we're going to see? You can make an argument for that being most likely the case. But I'm going to tell you what it would take for rates to go even lower, if that's going to happen again, and what to watch for. So let's first of all start off by taking a quick look here at mortgage bonds. So this is the reason that we need to pay attention, because if we can see here, we just draw a line. This is the trend right now. Okay, so this is what's happening. So mortgage bonds are going lower, which means that interest rates, unfortunately, are going higher. And now it's a very slow and gradual thing, which is good. We like slow and gradual when we're talking about bonds or really the financial markets at all. Slow and gradual is good really either way. It just means that things aren't out of control. Of course, that's not what's happening in the stock market today. It's absolutely all over the place. But in the bond market, which is what matters for mortgage rates, this is what we're seeing. So slow and gradual decrease in the face value of these mortgage bonds, which means that the rates, the yields associated with them have gone up. Now this is keep in mind, we're talking about from the all-time lows. Like this was the ultimate time to lock. You can see 3 lock alerts here from Barry Abib, mbshighway.com, at the absolute best possible time to do it. And locked a lot of people in here. And I locked a lot of people in here. And that's the ideal situation, to be in a situation like that. Now, what's caused this, though, is not the natural market. So the thing that's concerning is not the fact that we see this slow decline in mortgage bond prices, but the fact that the Fed is in there. Remember, the Fed is buying every day. They're a huge buyer every single day on here. The Fed has been in there buying billions and billions and billions of dollars worth of these mortgage bonds every single day. So if you have a huge buyer in the market and the price is slowly decreasing, that tells you that the other side, the natural side, the organic side of the market, there's a lot of selling. Now, why would there be selling? Well, remember, bond prices were a lot lower just 6 months ago. So there could be some profit taking. That's fine. We could be going down slightly. Just there's profit being taken by people who saw this coming, got in way down here. They're taking profit. You can do this with bonds just like you can stocks. You can buy a bond at 100 and sell it at 102 and make 2%. You do the same thing. And there's some people who trade bonds. Not everyone just invests in bonds. So that could be going on. But we're talking about a massive amount of that, though. A massive amount, and almost coordinated technically just perfectly to be just this slight overall trending downward. Now, we've crossed over, and we showed you yesterday. Let me see if I can clear this real quick. Is it C? Yeah. So we crossed over, unfortunately, and it looks like now the 25-day moving average is going to cross over the 50 here. Although we're sticking to the 50 for today, the day's not over. It looks like it's going to go even lower from here, and that this trend is going to continue. Now, this could all be incorrect. At any point in time, and I'm going to show you what the Fed said, it could maybe lead us to believe what they might be thinking or might be wanting to do. But at any point in time, they could double, they could triple the amount that they're buying every day. They could just say, hey, instead of buying $3, $4, $5, $6 billion worth a day, let's buy $60 billion. I mean, they could do that. They did that back in March. It really screwed things up because it went up too quickly, blew out the hedge on every single bank and caused a lot of problems. They could do that. I don't think they'll do that again, but they could slowly, incrementally increase their purchases and run this again higher. But to that point, let's go ahead and let's take a look. Make sure this is working. Yep. All right. This is going to look a little weird. So here's what Powell said. This is a summary of some of the things from CNBC. He said, hey, we're not out of ammo. Now, remember, the way that the Fed thinks about these things is sort of like if you were dieting, but you were eating ice cream for every meal because you like ice cream, and you weren't gaining any weight. That's kind of how the Fed looks at this. They don't care that they're on a diet of straight up ice cream. That's not what they're concerned about. They're just looking at certain numbers, and they want those numbers, inflation, to be at a certain level, and they've gotten more relaxed about the way that they're looking at that. But he's saying we're not out of ammo. They're never out of ammo. It's just numbers on a spreadsheet at this point. It's not like they even have to print the money anymore. It's just numbers on a computer. So no, they're not anywhere near out of ammo. They have plenty of ammo, and they're not afraid to use it because they stay thin no matter how much ice cream they eat. And even though this announcement should have been really positive for stocks didn't react as greatly, I think, as many people expected. Powell says that almost all forecasters expect more stimulus from Congress. Of course, they're working on a deal right now. That was kind of obvious. He said, hey, Fed will keep rates low until inflation holds above 2% for some time. So not only did he say we're going to keep rates low, but we're going to keep rates low until we actually see inflation go above 2% and stay at 2% for some time. Now, that is pretty interesting. And this should make everyone really bullish on the banks. That's why they put the bank spider up here, the S&P bank spider, because it's like, hey, that's really good for banks if they can keep rates. Because when we're talking about the Fed rate, remember, that's not mortgage rates. The Fed rate is the overnight lending rate that banks are able to borrow money from the government, the quasi-government known as the Federal Reserve. So banks are able to get money from the Federal Reserve to then turn around and lend. And they can, if they're getting that for 0 or a quarter, right now the window is 0 to 0.25%. If they're getting it for that, they can turn around and lend it for 3, 4, 5, 6, 7% and make great margins. So the banks are in really good shape with this low rate environment, but it doesn't necessarily translate to mortgages. Remember, because in fact, the Fed lowering interest rates in the overnight window, or essentially bringing the prime rate down, that actually causes people to run to stocks. Right? Because you can't get any money in your savings account anymore. So people are running to stocks, people buying stocks. And remember, when the stock market goes higher, rates tend to go higher. And that's what we've seen. So that correlation, thank the Lord, is still in place, because if that gets broken, then I don't even know what to tell you. I can't even make videos anymore. There's certain things that we expect because they make logical sense from a financial perspective. And if those things break, then everything's going to hell in a handbasket. So we're looking at this and saying, okay, well, that's a good thing. Like I said, even the slow decline in mortgage bonds is a good thing to see, because that's how the market should move, even though it's the wrong direction. We don't like that direction. So let's see. Do they have any more updates on here? I thought they had one. Oh, yeah. He said, so he said hold rates steady and promises to stay here for years. And okay. And that was it from the summary. I thought there was one more thing that he said about the stimulus, but anywho. So basically what he said was we're going to make sure that the banks are in good shape for lending money, that people can, get low rates on car loans. This is the prime interest rate, but it doesn't have anything to do with mortgages. So I think when people heard that, hey, the Fed is going to keep rates low for years, they immediately thought that translated to mortgages, and it's just simply not true. That isn't what they were necessarily talking about. We need them to buy bonds and push these prices higher if we're going to see lower mortgage rates. So that was not mentioned. Now, they can make this decision, though, without having to go through Congress or anything. They can decide today, this afternoon, that, hey, we're going to just start putting more money into mortgage bonds. But I think because the refinance activity has been so extreme, I think because especially the big banks who suck at mortgages, I think because they're the ones who are mostly in the Fed's ear, they're going, yeah, mortgage rates, don't worry so much about those. We're good there. We're great. We have more business than we can handle. Don't worry too much about that. I'm sure that's what's being said, because they're not that concerned about it when they have way more business than they could possibly handle. They already stink at doing mortgages anyway, so they don't need any more of those. Now, if we started to see home buying numbers struggle, which we haven't, then maybe they will come in and step in. But I guess my point here is that because we have not seen there be a struggle on the home buying front, the numbers are huge, prices are going up, all those things seem to be working. The Fed kind of feels like, we did it. We came in, we've been buying bonds, we got the market stimulated, people are buying houses like crazy, people are refinancing like crazy, everyone's too busy. They're not worried about this right now. That's the concern. And will we get back to these levels? We could, but only if the Fed decided that they wanted to step up and do something, and they are not going to do that unless there is a big reason to do it. And right now, there's no reason to do it. Remember, these are what I call bow tie guys, right? They just look at numbers on sheets. They're not in the market. They're not, even if they're buying or selling a house, they don't even know what's going on. They're not in the market. They're not talking to realtors. They're not talking to lenders. They're just looking at the numbers. And the numbers right now say that they did it. They're a screaming success. Everything that they were aiming to do, they've done, and it has worked, and it is currently working, and they don't need to do anything else right now. And until that changes on the sheets that they look at, whenever they get together about this stuff, until the numbers change on those sheets and say there's a problem, they're probably not going to do anything here. And if the natural market, even with all their buying, is pushing prices lower, in summary, we could see rates go up. We are seeing rates go up. We could see rates maybe stay here. Maybe they'll flatline here. But getting back to these levels could be tough. Could be tough. Tougher than it should be. Tougher than it should be when you have such a big buyer in the marketplace. So have we seen the lowest rates? It's possible. It's possible. I'll be honest. I'm floating. I have a lot of people who are floating. If we do come back up, and there is nothing to do with the Fed. Let's clear this again. So this is the other point I want to make. If we do get back up to this level, these are the best levels right here of all time to lock mortgage rates, the lowest mortgage rates in history right here. Can we get from here to here? Yeah. If we do, though, remember, look at how it happened. It was quick, boom, up, and then we're out. So, and these are days. So if you're someone who's looking to refinance, and I'm going to talk about a couple different strategies for refinancing maybe tomorrow. Also going to talk about renting. I have several videos I want to make here soon that I think are important and pertinent to the moment. These are each one day. So if you wanted to capture the absolute best, which was really this day and this day, you needed to be in a position to lock prior to that. So if you're waiting to refinance for the perfect rate or for rates to come back to these levels, just know that when they get there, a lot of times it's quick. Because when you hit all-time highs and when you hit these really big ceilings, there's a lot of sellers there because there's so much profit to be made by selling and just turning those coupons over and then coming back and buying them back here at a slightly lower level. That spread is big. When you're in big boy world, which is where you are when we're talking about bonds, these guys are trading the trade orders for $25 million, $50 million, $100 million. That's the trade order. So they're making enormous moves on these things, and every single one of these ticks is huge. So, when you talk about how to capture this, how do you capture the absolute lows? You got to be in position ahead of time over here. So the best thing you can do, whether you're using myself to do your refinance or someone else, doesn't matter. You want to have your application in, okay? Be in position to lock. Each company has different rules about what is required for a lock. If you're doing a VA IRRRL refinance, for example, all I need is your application and I can lock your rate. So we can do that actually pretty quickly. You can fill out your app in 15 minutes and boom, I can go lock you. But if you're doing like a conventional refinance, like in my company, for example, you have to have an appraisal ordered. Some companies you have to have an appraisal in. Some companies you have to have an underwriting approval. Some companies actually make you be clear to close before they'll accept the lock. So you need to know who you're working with and when you can lock in the process, and you need to get yourself set up ahead of time for that process. Now, if you're buying a home, this is something where a lot less concern can be given towards this, because if you buy a house and you get 0.5% rate higher than the absolute lows or whatever, that's not a bad thing. That's actually a great thing, because remember, when you're buying a house, it's much more important to find the right house than it is to get the right rate. I mean, if you get the right rate in the wrong house, that's not a win. If you get the right house and the wrong rate, hey, rates could go down. You could take advantage of it, So it's much better to get the right house than it is to get the right rate. And I've seen people mess that up, and trust me, you don't want to be in that boat. But this is what we're looking at. This is the reality. So if you want to refinance, you want to time the market, what you have to do is get your application in and then be ready to pull the trigger on the lock, and make sure that your loan officer is subscribed to MBS Highway. Make sure you ask them that. Make sure you ask them about mortgage bonds and what they think, because a lot of people have no clue what's going on with this. And if they don't, they're not going to have a prayer at locking you at a good time. They're just going to lock you whenever you come down the assembly line, and that's just like flipping a coin, man. Go to Vegas if you want to play that game. All right, guys. So I don't want to beat the dead horse here, but if you have questions about mortgages, VA Home Loan Specialist, Derrick Evans here, NMLS 155010. If you're a veteran, if you're looking to refinance, if you are buying a home, want a second opinion or whatever it may be, give me a call. If you want me to look through any paperwork for you, a lot of times lenders are sending paperwork. People are just overcharging the heck out of veterans for VA loans these days. It's driving me crazy. The stuff I'm seeing every day, driving me crazy. I may have to start an activist group. Seriously. We may have to start a nonprofit activism group because of the things that we're seeing every day here, people getting ripped off. And what's crazy is some of them will talk to me first, and then they'll go get ripped off by somebody. I just don't get it. But it's happening. Don't allow it to happen. We can look through the paperwork. You shouldn't have to pay any fees or any fees at all to get a VA loan, but especially all these crazy origination points and all this stuff. You don't need to pay that. You don't have to pay that. Not every VA lender is the same. A lot of people believe a VA loan is a VA loan is a VA loan. It's not. Every lender is different. Their overlays, minimum credit score requirements, fees they charge, everything can be different from one lender to the next. So if you know someone who's looking for a VA loan, have them give me a call or a text. I'm happy to help. And hopefully this video is helpful in helping you save money and be smarter than everyone else. Thanks, guys. Please share.